Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, private family offices, registered investment advisors, and investors like you to help them get better returns in the stock market. I'm here again today with our favorite co-host, Robb Fahrion, who is the founder and CEO of Flying V Group, our marketing partner. Robb, thank you so much for being here with us.
Thanks, Gary. Appreciate it. And I think we're going to have a little bit of a different tone on this particular five things. I know it's been a little, not doom and gloom, maybe, but a little gloomy over the last couple of weeks.
Yeah, that's right. And look, there's a reason why, we've been a little cranky recently. If you're watching this and your grocery bill is high and your rent is hard to afford and you've been dealing with the effects of inflation and an irresponsible Federal Reserve and crazy government spending, you can see why this stuff bothers us, right? It's the markets are no longer engaged in what we like to call price discovery, which is just a rational exploration of how much these things should be worth. It's being led by incompetent people at the top. And that, of course, makes us a little cranky. That's why we've been negative in some of our recent pieces. But this week, we were calling this episode the smart people doing smart things issue. And the reason for that is because we had a ton of good news. And not necessarily, positive life's going to be wonderful news, but people acting in a smart, responsible way. And so this week we are all positive and celebrating the good choices made by other people and talking about how smart other people are for the week. And we're just going to take a different tone and happy to do it.
Like that, and I'm sure our viewers will too. Remember, if you're watching this, you're not subscribed, be sure to sign up for a free subscription on deepknowledgeinvesting.com. You'll get this delivered to your inbox in terms of the five things on Wednesdays. Premium subscribers receive this on Monday. Five things on the docket, and hang on till the very end. We actually got a little special segment. I know how much you like surprises, Gary, but I got something special for you at the end. But we're going to be talking Moody's and what they have to say on China, LVS once again, some Bitcoin, Peter Schiff conversation. So let's get right into it with the first thing. New payroll and jobs data is all things to all people.
Right. Okay. So for everybody who isn't spending all day on financial news like we are, there is a reason that the market has been riveted to payroll information for the last 2 years. And that's because the Federal Reserve is following this information really closely. The problem that they have is something called a wage price spiral. And the fear that the Federal Reserve has is people are getting paid more because the labor market is tight. Tight is simply a fancy way of saying there are more jobs available than there are people to fill them. And so when that happens, employers raise prices to attract new workers. And as they raise wages, I said that wrong. As they raise wages to attract new workers, the new workers get paid more. Well, when those businesses now have more expenses because they're paying workers more, then they raise prices. And that makes inflation higher. That makes the goods more expensive for all of us. And then what will end up happening is people will say, hey, my job doesn't afford me a decent quality of life. And then they want higher wages. And there's nothing wrong with wanting to get paid more. But from the point of view of the Federal Reserve, they actually, as horrible as it sounds, want to slow that down, because the more people get paid, the more we have inflation, the more life becomes unaffordable, and the more raises they need to get. So the stock market has been looking for a decrease in tightness of the labor market. The stock market is hoping to see smaller wage gains and fewer job openings, giving workers fewer options and less bargaining power. Again, I know this sounds horrible to all of you. It really does, but this is the way the financial world works. And I would love to give you a prettier story on this. It's my job to tell you the way it is. So the data that we got last week, first of all, private payrolls grew 103,000. And that's actually a good number on an absolute basis. Remember, anything that's positive means more people are employed. We're going to celebrate this. This is great news. The bad news on it, and this is why we're saying the jobs data is all things to all people, it was below expectations of 128,000. So we got a good number, but not as good as expected. And then last month's job growth was revised down to 106,000. So what we have here is positive growth, but at a declining rate. On top of that, wages were up 5.6% for people who were in the same jobs and 8.3% for job changers. Now, again, this might sound complicated for you guys, but it's actually really simple. If you stay in your job, maybe at the end of the year or after your review, you get another 5-6% wage hike. For people who quit their jobs and take the risk of starting something new, they're getting paid 8 or 9% more. And that's kind of how these things tend to work. But the key point here is that quits are down, right? So we have fewer people quitting their jobs to go try to work for for another firm. And the reason for that is because the number of job openings has now fallen from a high of around 12 million down past the expected 9.3 million to 8.8 million. Again, 8.8 million job openings is a big, great number. It shows a very strong labor market. If you are in the United States and you want to work, there are opportunities. But the number is down from where it was before. And so we're starting to see some loosening of the job market. And as some of those opportunities dry up, workers are deciding to stay put in their current jobs and not necessarily try to make that move. And that also is keeping wages down because those people are getting maybe the 5% raises instead of the 8 or 9% wages. What do you think, Rob? Too complicated, or does that make sense?
My question would be, what bucket does Gary put this in terms of good, bad, or indifferent would be my question.
So Wall Street likes to go off of expectations, right? If you're running a company and people expect that you're going to do 45% growth and you do 40% growth, people get really disappointed, right? These numbers were a disappointment to the market. My view on it is a little bit different. My view is we have an unemployment rate of 3.7%. That is very, very low. We have almost 9 million jobs available. There are more jobs available than there are people looking for jobs. We have continued higher employment, meaning more people are getting jobs and joining the labor force. Yeah, the numbers might not have been as good as some people expected, but I actually think they're indicative of a strong economy and a strong labor market, and that we still have an economy where there's a lot of opportunity for people. And that doesn't mean it's going to be easy for everyone, Rob. There are reasons why some people can't get jobs. They may be in fields that are contracting. They may be in a part of the country where it's not popular. For instance, if you want to work in finance, being in New York or Greenwich or Palm Beach or Los Angeles or San Francisco, those could be good places to work in finance. But, I grew up in the Midwest, and outside of Chicago, there aren't tons of high-end jobs. There are some. There were good banking jobs in Detroit, and I did internships when I was a junior at the University of Michigan. But there are reasons it might be hard for some people. But overall, when we look at the national picture, I actually think the employment market's in pretty good shape and there are opportunities for people. So, I'm happy to see that. I'm always cheering for my fellow Americans to be able to get jobs and live good lives.
And remember, happy episode. So I might have cornered you into that answer, right?
No, listen, it's you always want to cheer for people to be working instead of on government assistance, to be in control of their lives rather than dependent on something else, to be able to make more money. And even people have complained, Rob, that some of these are entry-level service jobs that aren't going to pay a lot. That's okay, right? Like my first jobs when I was in high school and college were selling clothes for something in the neighborhood of minimum wage in a shopping mall. I worked at American Eagle. I worked at a place called Jeans West, and I sold clothes, but those jobs allowed me to start building a resume. And then when I went to look for finance internships, I was able to show, look, I've worked, I know how to be responsible, I can show up on time, dress properly, and I'm serious about this. And it helped me get those finance jobs, and those finance jobs then helped me get my first job out of school, which is doing mergers and acquisitions at Morgan Stanley. And basically, people act like those entry-level jobs might be beneath certain people or dead-end jobs, and I just don't agree. I think it's how a lot of people get a leg up and start to build a work history. And it's a path to success. And I always want to see, the American people have a path to success. And I realize, we're intentionally trying to be positive this week, but I mean that, and I will say that, any day of any week at any time. That's what's good for all of us. And so, if you're looking for a job, go for it. There are opportunities out there. We want to see you succeed. And, when you get it, just post it in the comments and we'll celebrate it with you.
Yep. Every opportunity is a stepping stone for sure.
Yeah.
Moving to China. Thing number 2, Moody's came out, put China on downgrade watch.
Yeah. So, Moody's is typically late. Sorry, everyone. This part isn't so positive. We might have
We
put these out of
tried. We
order. I know
tried.
we're doing our best. So Moody's is typically late. As a reminder, Moody's and the other ratings agencies downgraded all of the banks in 2008 after they'd lost billions and billions of dollars in the financial crisis, after they realized the collateralized mortgage obligations they owned were toxic and where they had tons of exposure that they shouldn't have had. Moody's is always late, but we also think they're right on China. China has massive amounts of debt. They have an over-leveraged banking sector. As much as we like to complain about US banks, their reserves are pretty strong. Unfortunately, we've been in a lot of situations over the last couple of decades where the Treasury Department and Federal Reserve have bailed them out. DKI is not in favor of that. For those of you who are angry about past bank bailouts, we are 100% with you. I completely agree. But right now, a lot of banks are here in decent enough shape, not enough that I want to buy them, but, decent enough. But in China, they have massive amounts of leverage. And because they have a top-down economy, in many cases, the banks have to lend to certain sectors, whether it's wise to do so or not. And in a lot of cases, the Chinese government will mandate certain performance goals. And so the local governors or the local politicians will simply make up the numbers because they don't want to be punished by the party. China also has a crazy, crazy property sector. In the United States, people tend to save in the stock market. They tend to save and invest in the stock market and maybe their homes. In China, it is property, property, property. There is an issue there where if you want to get married and you don't own your own apartment, it may be very difficult to get married. And certainly we share kind of a cousin to that in our attitudes in the United States, where people will often delay marriage until they can afford a down payment. But in China, there's no way young people can afford their over-leveraged, over-expensive property market. And so what they'll often do is families will go into massive amounts of debt in order to put a down payment down on a piece of property, because it's the only way their child will be able to get married and provide them with grandchildren. It is like literally their entire their entire marriage market goes through the property market. Now, where things get really crazy is you have companies like Evergrande, which we've all talked about over the last year or two, where they've taken these deposits, but the companies don't have enough money to finish construction. And so one of two things is going to happen. Either companies like Evergrande declare bankruptcy, a default on their obligations. Families have gone into debt to put down deposits and they're not going to get anything, and that will crash the banking sector. The alternative is that the banks back Evergrande and some of the other property developers in China. They provide the apartments, but the issue is they don't have enough financing for it. And guess what? Now we have more pressure on an over-leveraged banking sector. No matter what happens, these guys are in bad shape. And China also has high prices and an oversupply. They have these ghost cities of apartments that are trading at insanely high prices because this is how Chinese people are storing their wealth. When that reverses, it's going to reverse very hard. And people who paid a lot for property and went into debt to buy property are going to find out that the market value of what they own, if they're able to receive it, may be less than they expected. Moody's looked at that and said, you know what, maybe things in China aren't as good as we thought and hoped, and put the entire country's debt on downgrade watch.
Interesting. Where any ideas on the origin between the cultural owning of a home, marriage? How is that? Is it like an unwritten law? I'm just actually curious. That's the first I've heard of that. Any additional color on that and how they set that up?
Yeah, it's definitely custom and not a law. There's no law in China that says you have to own an apartment to get married, at least not one that I'm aware of. But, they basically wealthy or successful families or families that want to become successful, don't like the idea of their son or daughter marrying somebody and not having enough money to have an apartment. It's a display of wealth. And, listen, it's very easy to pick at the Chinese culture for being a little bit of a mercenary culture when it comes to marriage and saying, we only want to get married if there's this much money on the table or if assets are this or that. But, unfortunately, that's been a function of marriage in many, many societies for centuries.
Sure.
And, in the United States, it's maybe not so formalized, but I think you tend to do a lot better in the mating and dating market if you have a lot of money and a nice house than someone who's, maybe living in their parents' basement. That's, that it's just so it's easy to make fun of the Chinese for this, but every culture has some version of that.
Right. Makes sense. With China, anytime we talk about that, DKI subscribers, I'm sure, are interested. What does this mean for LVS, Las Vegas Sands? So in true fashion, coming up at point number 3, LVS actually shrugs off Moody's and buys more Sands China.
Yeah, so this has been a fascinating situation because we've looked at this incredible bifurcation between Sands China and Las Vegas Sands. So let's do a little explaining here. If you own Las Vegas Sands stock, the ticker is LVS, it trades in New York. What you own is the Marina Bay Sands, which is the massive, incredibly profitable resort in Singapore that owns half the Singaporean market and where they're currently doing construction. And you own 70% of the company's Macau assets. And they own half a dozen hotels and resorts, casinos there. And those are some of the most valuable gaming assets in the world. And they're now recovering really quickly. So that's 70% of the Macau assets. The other 30% of the Macau assets are owned by a company called Sands China. And that trades in Hong Kong under the ticker 1928.HK. And so what we've seen, or what we saw last week, was as there was all this news, the previous week was Miriam Adelson, Sheldon Adelson's widow, selling $2 billion of stock, except Las Vegas Sands grabbed $250 million of stock in a stock buyback at a discounted price. Great job by Robb Goldstein and management there. Now, what we saw was Moody's downgraded China, and the US market said, oh no, the Chinese economy is in trouble. So what we're going to do, is worry that because the Chinese people are under financial distress, they won't want to gamble. Well, and so the price of Las Vegas Sands in New York fell on that. At the same time, people in Hong Kong saw that they and their friends were constantly going to Macau and that the gaming tables there are full, the hotels there are full, and the company is rapidly returning not only just to pre-pandemic performance, but some of these properties are putting up performance that's better than what they had in 2018. They're putting up results that are literally all-time highs. And they see that. And so the stock price of Sands China, 1928.HK, was going up while Las Vegas Sands was going down. Las Vegas Sands being smart and opportunistic. See, now we're back to the positive end of this, smart people doing smart things. They went to Sands China and they said, you know what? Here is $250 million. We're going to buy back a bunch of Sands China. And so instead of going and trying to acquire gaming assets or casinos that they maybe don't know well, maybe in markets they don't know well, where they don't know what's going on with management, Robb Goldstein and Sands management said, there are no assets in the world we know better than our super well-performing, recovering Macau operations. And they went to Sands China and gave them $250 million and bought back a bunch of their stock. This was $500 million of stock buyback by Las Vegas Sands in 2 weeks at discount prices without taking on more debt and without interrupting the construction and growth capital that they have going on in both Macau and Singapore. If you want to know what smart people doing smart things looks like, this is it. And it created all of this activity, created a temporary downturn in Las Vegas Sands, LVS trading in New York. But the truth is, management created a ton of value for shareholders, taking a lot of discounted stock out of the market on our behalf. We totally support the move. We think it was a really smart move. And in exchange for some short-term stock price volatility, we have permanent retirement of those shares. And now as shareholders, we own more of these great recovering assets. We love the move.
Great. Very exciting news. Moving on to Peter Schiff, and I know you have some disagreements with him in regards to Bitcoin. He makes the moral case for property rights. In the email version of the 5 things, you're going to see a tweet from, or an X, whatever we're calling it now, from Peter. So if you can give some of the watchers some context around the tweet, Gary, and then the fact that you do support what he was saying in this regard.
Yeah. First, let's talk about Peter Schiff for a minute. He's a smart guy. He's an excellent analyst. He's a really good economist, and he's a great communicator. Peter's been positive on gold, like deep knowledge investing, and we are as well. And like deep knowledge investing, Peter understands that the fiat dollar, the dollar being issued by the United States Treasury and sometimes created by the Federal Reserve, is being debased. And that's a fancy way of saying they're increasing the supply, creating inflation, making the value of the dollars in your pocket, in your savings account, worth less. Peter and I agree that this is wrong, and he's done an incredible job explaining that to people. And to that end, I totally support him. I think he's a smart guy, and I think he's pointed in the right direction. Where Peter and I disagree is he's been very, very negative on Bitcoin. In my opinion, he often doesn't explain his position very well. He just sort of says it's worthless. At Deep Knowledge Investing, we like to hear the word because in a sentence. Okay, you think it's worthless because, and, explain it. And, at Deep Knowledge Investing, we're very excited about the coming conversion of exchange traded funds that can own Bitcoin. So we own GBTC, the Grayscale Bitcoin Trust, and it's trading at a discount. And when the SEC approves that, we'll be able to buy, we've been buying Bitcoin at a discount, and that discount will close. And Peter's saying, no, it's all going to disappear after the approval. But again, there's no because in there. And in this matter, even though he's somebody that I respect, he sort of fulfills that embodiment of, the old meme, old man yells at Bitcoin, right? But there's a case in front of the US Supreme Court right now regarding property rights. And it's an important case because the case will allow the government to tax unrealized gains. And basically that will allow the government to force you to sell assets that you own in order to pay taxes on gains that you haven't realized. And you know what? It's long, but I'm going to read Schiff's tweet here because it's brilliant and it's important. And everyone, I apologize. This is long. These are Schiff's words, and I agree with him. And 3 cheers for Peter Schiff for saying this. Sorry, this is long, but it's really important because when it comes to property rights, these things matter. And Schiff's words are, if the Supreme Court rules in favor of the government and allows it to redefine income to include any unrealized appreciation in any asset, then it will grant the federal government a new power to nationalize the entire asset stock of the nation. In hyperinflation, the only refuge people have is the ability to hold real assets and never sell them. But if the federal government can claim unrealized inflationary gains as being taxable income, then almost all Americans will be forced to sell their assets just to pay their tax liabilities. But with all assets up for sale at once, the most likely buyer will be the federal government itself, which will pay in near worthless paper. In one decision, the Supreme Court would have rendered the Constitution meaningless, effectively illuminated, he wrote illuminated, but he meant eliminated, private property rights, and provided the federal government with the legal mechanism to pull off a communist revolution without having to fire a single shot. These are powerful words. I'm going to make 2 points. One is Schiff is making the case for economic freedom. there is no prosperity without property rights. There is no liberty without property rights. When it comes to the moral end of this, Schiff is 100% right, and I support him completely. The second thing is, I do follow Schiff on X, on Twitter, and in a subsequent tweet and part of another discussion, he made it crystal clear that his words also apply to the Bitcoin maxis, the hodlers, right? Those of us who own and self-custody Bitcoin and are going to hold them no matter what. And he made the point that if the government is allowed to do this, they could then say, well, the value of your Bitcoin has gone up, so go into your cold storage, pull out some of that Bitcoin and sell it, and then give us the proceeds. And by changing the tax rate, they can force you to get rid of hard assets and shift into fiat dollars that they can debase. And so we credit Schiff for a few things. One, for his astute analysis. Two, for his defense of freedom. And three, for making it explicitly clear that his words, his message applies to people who own assets that he doesn't approve of either. By extending his defense of property rights even to us Bitcoin holders, who he's against on Twitter on a daily basis, DKI thinks he's acting with integrity and with genuine intent. And for that, I admire the guy. I really do. Like, 3 cheers for Peter Schiff for being smart and principled and acting with integrity. I couldn't be more supportive of him on this. And so thank you, Peter Schiff.
What are the next stepping stones, Gary, to look out for in terms of, where this is at, in the timeline of discussion? Is it in front of the court currently? Any insight on that?
Rob, it's a great question. And I'm aware of the case, but I haven't followed it as closely as Schiff has. But what I can do is I can certainly check in, with Phil Kessler, who is Deep Knowledge Investing's one of our legal advisors on the board of advisors. Phil actually has argued in front of the U.S. Supreme Court before. He represented the University of Michigan in a case that went through the court and knows a number of the justices personally. He would know this, and I'm happy to check in with him, and we can revisit this in a later 5 Things discussion when I have better information. I'm always willing to tell you, I don't know, but we can find out.
Perfect. Thanks, Gary. Wrapping up with point number 5, Bank of Japan crashes the yen and takes aim at the U.S. stock market.
Yeah, so here's what's been going on. Japan has a debt problem. Debt to GDP in Japan is well over 250%, and making things worse, the only way they've been able to afford that is by keeping the yield on government bonds at insanely low levels. Japan has had a lot of 0 and negative rate debt over the last few years. They've thrown in the towel a couple of times, I think 3 times in the last 12 months, where they've started to let the yield on the 10-year float a bit. But just to give you a sense of how far behind they are, actually, let me take a look. I've got this up on my screen, right? So right now, the yield on the 10-year Japanese government bond is 0.71%. Pardon me, I looked at this yesterday. The yield on the U.S. Treasury, the 10-year, is right around 4.2%. On the 20-year, I think it's 4.5%. I don't have the yield curve in front of me, but this is from memory. If I'm wrong, I'm pretty close. So basically, what's happened is people have said, wait a minute, the Japanese yen is yielding 0.7%. U.S. Treasury is 4.2. What they're doing is they're selling yen, buying dollars. And in doing so, they're short something that yields 0.7%. They're long something that yields 4.2%. And they make that spread. It's called the carry trade, right? So they're making that 4.2 minus 0.7. And then, they can be leveraged up. And then they further benefited from the fact that Japanese policy has ensured that the yen has plummeted. So, back in 2022, there was a point where, it was 110 yen to the dollar. And then it fell to something like 152, 154 yen to the dollar. That is a huge hit, right? Try to imagine the inflation we have here in the United States, how bad it would be if the dollar fell 35% against the other countries we import from. That would be a massive problem. And so, with the yen plummeting and creating problems for their citizens, the Bank of Japan is now starting to say, you know what, we're going to maybe be open to getting rid of this negative interest rate policy and letting their rates rise. So here's what happens. Let's follow this through on the Japanese side and the US side. Okay. So tomorrow, the Bank of Japan comes out and says, okay, we're going to have higher interest rates, right? On the Japanese side, the yen will strengthen because people will want to own a currency with higher yields. But the problem for Japan is that means they'll have higher interest expense. As they have higher interest expense with a gigantic government budget, what will they have to do? They'll have to print more yen. Well, that creates more inflation. They will basically get more of the problem that they're trying to avoid. This is why we've been calling it a sovereign debt death spiral. They're at the point where no matter what they do, their sovereign debt is in trouble. But here's the issue for us in the United States. Let's say the Japanese government allows the yield on their 10-year to go up and gets rid of the negative interest rate policy. That will strengthen the yen. And when that happens, it makes the carry trade less attractive. So people will unwind this carry trade. Now, don't worry if it sounds complicated. We can explain it in the most simple way possible. It means they sell dollars and sell US treasuries, right? And they buy yen and buy Japanese government bonds. Okay, so here's what that does here in the US. Selling dollars makes the dollar weaker, and that means more inflation. And selling government bonds here means a higher yield. Well, what happens when we have higher yields? We saw that last year. You end up with lower stock prices as longer duration assets, like maybe some of the mega cap tech firms, end up having higher discount rates for longer periods of time. And so, the Bank of Japan, believe it or not, is actually in a position to pressure both the US bond market and the US stock market by allowing their rates to rise. So basically, last year and this year, they crashed the yen. Next year, they may crash the US stock market.
Great. And the bright side of 0.5?
Yeah, hard to find one on that. It's.
I think we're 3 out of 5 on our 5 things. We're getting there.
What can I tell you, people? I'm doing my best. Actually, no. You know what? Let's give them credit. Like the US Federal Reserve and like the Bank of England, the Japanese central bank, the Bank of Japan, has made some horrible mistakes in their past. Like us, like England, the UK, they kept rates too low for too long and they took on too much debt. They're actually doing the right thing now for their own country. The fact that it could create problems here, that is not the business of the Bank of Japan. Right. Look, I'm not interested in seeing us suffer here or have problems, but the Bank of Japan, after years of doing the wrong thing, is now actually focused on doing the right thing. And if the theme of this week is smart people doing smart things, it's not necessarily, does it make Robb's life better? Does it make Gary's life better? Right. Are they doing the right thing? And I actually think it is the right move. I think the Bank of Japan is starting to realize that their policies have been destructive. They're trying to reverse that, and they are doing the smart thing here with, predictable results.
Great. Thanks, Gary, for the 5 things for this week. As I mentioned at the top, we're going to enter into a little bonus segment. We've been doing this for a few weeks. I think it's important people get to know you a little bit more, Gary. So we're going to do a 5-question rapid fire. I think you might have read my notes because you answered a couple of these already if people were paying attention, but that's okay.
I haven't seen the notes.
Are you ready to go?
Yeah, wait, hold on. Am I allowed to say I don't know?
Yes. I hope you know all of these. One of them I might know. I might not know for myself, so I'll see if you remember, which will be good. So
all right,
let's get started. Gary, where were you born?
In Detroit.
Great. Your first job. This was the one I think you covered earlier.
Yeah, okay. So we'll go back. Yeah, the first official job was at a place called the Shirt Box in Southfield, Michigan, working for Ron Elkis. It was back at a time when men wore suits and ties, and Ron had a store specializing in men's dress shirts and ties, and I worked there selling, and Ron's a good guy and helped me learn how to make sales, how to approach people. He's terrific. But if you want a real answer to that one, Rob, when I was 7, I really wanted a Mattel electronic football, that handheld thing with the
Oh, yeah.
LEDs. I was so excited about it. And so that winter, every time it snowed, and I assure you in Michigan, it snowed a lot, I would go out with my shovel. I would shovel my neighbors' driveways. I'd be out all day, and I'd shovel their driveways for $1. And at the end of the winter, I called all the local toy stores, found the place that had the Mattel electronic football at the lowest price, and went to my parents. I'm like, I need you to drive me to the toy store, and they did. And I traded an entire winter's worth of snow shoveling for the game I wanted. And I guess even at 7 years old, I understood deferred gratification, hard work, and investing. And I still love video games today. So, maybe that was really like my formative job there.
Love it. Oh, should have held on to that. That's got to be probably worth something nowadays.
I'm so embarrassed, Rob, but I still have it.
There you go. All right, good to know.
I still have it in my closet at home. It's really embarrassing, but I still own it. I suspect it works.
Yeah, I love that. All right, this one. First stock you ever traded, or first big trade you can maybe remember.
Oh God. So when I was in college, I wasn't trading individual equities. Just starting to deal with mutual funds and stuff like that. And then when I was at Morgan Stanley, um, I had access to non-public information. And so first of all, we didn't have time to do research, but if you're working in an M&A department, you're not actively trading stocks. After that, I went to go work for Doug Hirsch in the risk arbitrage department of Smith Newcourt. And so, we were putting on merger arbitrage positions. And we were also buying stock in thrifts, so that we're doing thrift conversions. So there was a lot of that stuff, but I can tell you the first stock I owned when I was 6 months old, my dad bought me 19 shares of Atlantic Richfield stock. And I remember like looking at the many, many decades later, looking at the history of it and wondering, what, 19? What a weird number, right? I mean, 19 is who buys 19 shares of something? And I'm staring at it and looking at it, and eventually I see it. Those 19 shares were $247.50. And all of a sudden, I saw my dad as a 27-year-old man with a wife and a home and a 6-month-old baby. That was me. And he was trying to provide a good life and trying to save for the future. And he had $250. That was it. My dad, as a 27-year-old man, did not have enough money to buy that 20th share to make it closer to an even lot. And I remember looking at that trading record and seeing it. And all of a sudden, I saw my dad at his desk and I saw all the pressure he had on him. And I called my dad and I said, "Hey, Dad, this is the story I get from looking at the record here." He said, "Oh, yeah." He said, "You've got it." He said, "I had migraines every weekend. I was working so hard. I just wanted to make it all work." And he said, "I remember sitting at my desk, and I know I had a credenza behind my desk, and I could turn around, and I can still in my head see where on that credenza that paperwork was for you." Right? And
Awesome.
so, people often view financial statements as bloodless, but under certain situations, they tell a very personal story. And it was something my dad and I connected over as adults because we both understood the kind of pressure that he felt as a young man with a young family. And so, I don't know that my dad spends a lot of time on YouTube, but, if you ever see this,
He
thanks,
should for
Dad.
he should for this episode.
Yeah, we'll send him a link, but thank you. It was a great thing to do, and more than just, the money and the investment, that moment when I could see myself in your shoes, that moment when I understood what it felt like just for a minute to be you. And then we could talk about it and share that, that meant a lot to me. So, everyone, my dad's name is Harvey Brode. Send him some good wishes. And Dad, thanks. Thanks for that sacrifice, for that investment, for that moment together. I will always remember that story. And, when people say, oh, stock traders, it's bloodless. And no, there are times that these investments have personal meaning.
Very cool. Thanks for sharing that, Gary. 2 more questions. I know you travel a lot. Favorite vacation spot?
There are 2 places. So just so you know, I'm filming this from Boracay, Philippines right now. It's hard to turn my camera, but I'm like right outside my balcony. I have a view of the beach and this blue-green ocean and mountains behind it, and it is spectacular here. But there are 2 places that I adore. Peru will always have my heart. The people there are sweet and gentle and kind. Their history is fascinating and well preserved. The food there is amazing. I've always loved Peru. I also love the sweet calm of Thailand. Bangkok may be a busy city, but the people there are very kind, very gentle, very welcoming. I'm not a Buddhist, but the Buddhist temples there in Thailand are stunning. They're beautiful. They have these colored mosaics on the outside that just glow in the Thai sun. And I've actually gone for evening prayers when they're chanting. Again, I'm not a Buddhist. I don't go there to chant and pray, but I sit with them and I meditate. And they chant and pray and I meditate and we all breathe. And it's just a really nice place. I had an incredible trip last year to Nicaragua. I'd love to return. And next year in a Bitcoin pilgrimage to learn more about how to use Bitcoin and to better understand how hard money can transform an economy and a society. I'm going to make a month-long trip to El Salvador. We're already starting to plan that now, and you can expect there will be lots of content online, photos and videos of, what it's like. How do you buy Bitcoin? How do you store it? How do you spend it? And of course, the one use case that everybody gets excited about, I'm going to go buy a coffee with Bitcoin, which for strange reasons seems to be everybody's test for what makes something a currency. So when I buy a coffee with Bitcoin, everyone will have to acknowledge that it's a store of value and a currency.
You have to tweet Peter at that point.
Yeah, that's when you buy a coffee, you declare Bitcoin victory is the thing. So, that's all on my short list right now. Those are the places that, that I've really loved and where I am now and where I'm going next.
Very good. All right, last question. I know this is going to be difficult.
Oh no.
Give us one word to describe just current economic state.
Uncertain.
Great. Gary, thanks so much for your time. As always, this week's 5 things. Exciting. Thank you for always bringing new content, new information to the table. I know I especially appreciate it and have learned so much from you. And again, like I mentioned at the top of the hour, be sure to subscribe on deepknowledgeinvesting.com. There's a free subscription as well as a premium subscription, which allows DKI to continue to pump out such great resources and research, obviously with Gary leading the charge. So Gary, any final words for this week?
Yeah, thanks so much, Rob. And for people who are interested in subscribing, the stuff we talk about here is great. It's, the big macro stuff. And these are important issues to understand. For our premium subscribers, that's where we really work to help them make money, where we talk about the stock picks that I own. Last night, we had an amazing unrecorded webinar with a member of our board of advisors talking about 2 of the largest positions in our portfolios. We had incredible participation from our paying subscribers who were on and asking brilliant questions. Everybody on there learned something and got more comfortable with positions we own. A lot of important questions were asked. So if that's something that's of interest to you, come check it out, try us out. And if not, we'll be here next week and you're welcome to just follow along and be here with us. Thanks.
Thanks so much.
All right. Thanks, Rob. See you guys next week.